now. I think now it's written excellent. Let me see. Let me see. Let me see. Let me know if you can connect to it now. Lucky Johnny, let me know if you can hear me now. Lucky, let me know if you can hear me now. Let me know if you can hear me now. Okay, just tell me. Yeah, just a second, just a second. You can hear me on YouTube? Let me know if you can hear me on YouTube. On YouTube, let me know if you can hear me on YouTube. Okay, okay, okay. That is fine. Then why is it showing me chat? Interesting. Because on my end it's clear, but I can see there's a glitch on YouTube. What is causing this? What is causing this? Just a second. No problem. Let me try. Let me fix this. Just a second. Hold there. Probably, sometimes I came to realize TikTok, YouTube is sometimes very busy in the evening. So you're going to see that chat on YouTube. There's a chat session for YouTube. Okay. Hi, Lindsay. Just for the ones who are on YouTube, just a second. I fix this. There's a chat place for chatting on YouTube. There's a place for chatting. Yeah, this stream is not. Let me share a link. Let me share another link. Let me share another link. Let me share this link. Let me know. We are back. Feel for real, just confirm. Are you using the same link that is on my TikTok story? Let me see. Let me share these so that you're able to join. So I'm posting a link on YouTube. Let me share it. Just use on here on TikTok. Please kindly use it as quick as possible because I know it disappears in a few. It's going to disappear in a few. For you to rejoin. Reply. Use that link. Use that link that I have commented on reply. Let me see. This YouTube doesn't like, TikTok doesn't like links and stuff. Let me see. If you are on my YouTube, you should be able to rejoin. If you are connected to my YouTube, you're going to see the link, the live session. Let me know once you're able to do that. Let me know once you're able to do that. Feel for real, kindly copy this, kindly share this link on on TikTok. Oh, nice. Hi, Meshuko. Hi. So for the people on TikTok now, you can rejoin. I see now it's okay. Like the live when you join. Like the stream, like the stream. Sometimes TikTok get glitches. If you are following me on TikTok, yes, thank you. If you are following me on YouTube, then you should be able to see the new stream. You should be able to see the new stream. So make sure you subscribe on the YouTube account. When you subscribe to the YouTube account, then you're able to get to the next live. YouTube does this at this time when many people are streaming. Then sometimes the health of the stream gets distracted. Let me know. Let's get to a good number, and then we continue the stream from where we left. The name is Accounting and Finance Playbook. There's a link on my bio. There's a link on my bio. There's a link on my bio. I can't post it on TikTok here. Let me know. 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 You're going to see the one that is active. Let me know. Let me know. Let me know. The ones on TikTok, we are waiting for you so that we continue. I don't want to leave anyone behind. Come on, come on. Go to the link on the TikTok. Go to the link on TikTok. I'm continuing in the next 1 minute so that I don't keep others waiting. Okay, feel for real. Thank you so much. For the ones on TikTok, please rejoin. Go to the link, go to the YouTube account. I hope you have subscribed. I, Kelvin Degwa, yes. So deal with taxation. But today we are looking at the statement of profit or loss. For the ones who are yet to join on TikTok, please, we're about to continue in the next 1 minute. Remember, today we are looking at the statement of profit or loss. Make sure this is for you not to miss these sessions. Make sure you subscribe on YouTube. Once you subscribe, you're going to be seeing the live session that I am on. Okay. Let me know. Let me know. I think we are a good number back. Keep the chat. If you had asked any question and had not yet addressed, kindly rechat it. As I can see, this is a new chat. I had to restart the stream, okay, to get it to be stronger. Okay, so let us continue from where we left. For the people who are on TikTok, remember I am streaming on YouTube. So you go to my YouTube account. There is a link. You're going to find me there. Okay. So you are saying for allowance for credit losses. Remember. Let me explain this. Remember when we have let's say, for example, trade receivables of amount 1 million, say 1 million, as at 31st December 2025. What are trade receivables first? Trade receivables is when you've gone and sold to your client. You sold to a client on credit. Okay, we all know there are some clients who will not pay you. You went and sold and they not paid you. Some even they will declare bankrupt. There is nothing you can do. If someone declares bankrupt, then they have gone with your money. You see, there is nothing that you can do. You have to write off that. That is what we refer to as a bad debt. Okay, so if you have 1 million in the previous years, what you realize that in the past like 4 years, like a percentage of like 2% of what I have as my trade receivable ends up not being paid. Okay, so that is when IFRS actually brought in the allowance. Actually, it was the IAS as well. Now it's just that we are required more to do an allowance or a provision for trade receivables. That is the ones that will not get paid. You need to have that allowance so that in this 1 million that you're saying is a trade receivable during the period, remember, we might not collect it, all of it. In the next period, we might maybe probably collect 900. The other 100 you will have to write off. But remember, at the end of 31st December 2025, you wrote in your financials that you have these assets of 1 million. That is basically, we would say, overstating. Because you already know, I may not collect all of that. No, you have that doubt that you may not collect is 1 million. You will collect 100. you're only going to collect 900. So you really, the prudence, it's called actually prudence accounting principle. You have to make sure for anything that you're expecting a loss, make sure in a certain period. Remember, this 1 million relates to you this 31st December 2025, at the end of 31st December 2025. You have to make sure you account for it. Account for any loss that you're expecting, and also don't overstate your assets, and also don't overstate your profits. Now that is where this allowance for expected credit losses, it is the same terminologies: allowance for doubtful debt, allowance for bad debt, provision for bad debt, and allowance for expected credit losses. That is what IFRS uses mostly. Okay, it is the same concept. So let us go back to the question. I just wanted to give someone who doesn't understand what we mean by allowance for bad debt, and then just an overview. But there are videos I've done on allowance for credit losses. Okay. Then we have included in general expenses is 3 million relating to proprietor's personal expenses. Okay, this is a sole proprietorship, and there is 3 million that is in the general expense. That is what is recorded here is general expense. We note that these are personal expenses. Remember, one of the accounting principle is you're not supposed to have the personal expenses in a business expense. So you have to remove these. Okay. Then we have goods costing 5 million. They were withdrawn by the proprietor for personal use. The same principle. The moment we see this is going to be used for personal usage, we can't account it in the business. So if it is included there, we have to remove them. Then we are told the carriage inwards includes 1.2 million relating to carriage on furniture purchased during the year. Okay. So this 1.2 million is on one is for on furniture. So the carriage inwards total was 8 million. So part of it, 1.2, is for bringing in your furniture. Your furniture here is PPE. The other that is left is what was used to bring in your inventory. Okay. Inventory is what you buy to sell. Furniture, you're not buying furniture to sell. If your main business is to buy and sell laptops, the furniture you buy to support the office, and then the laptops you're buying to sell. Okay. A business dealing with buying and selling of, let's say, caps, they could buy a laptop, but when they buy a laptop, they're buying it for the accountant to use, the HR to use, or to, like, for office use. What you buy it for to support the business, it's basically PPE. What you buy to sell is inventory, or what is commonly also known as stock. Okay. Then here we are asked to prepare the statement of profit or loss. Okay. So what do we start with? Always remember, you have to do period end adjustments based on the information that you've been given. Remember, as an accountant, you are there, you've been recording, you know what has been always happening in the business. So this is in a practical scenario, real life scenario, you have this additional information to assist you to do this period end adjustments. Okay. So we have here first, let me show you the format for the statement of profit or loss. Remember, in everything that we create, first start with what? Start with a header. The name of the company, the statement of profit or loss, and for the period ended 31st December 2025. What do you note that is different here? When we are looking at the statement of profit or loss, we are talking about a period. We are talking about a period. Okay. We are looking at the period from December 2025 to December 2025, because we want to know the income that has been earned during the period and the expenses that have been incurred during the period, and then we are able to know the profit or loss. What is the profit or loss that has been earned or you've gotten during this period. But when you look at the statement of financial position, we are talking at the end, as at 31st December 2025, because we are looking at the balances as at that particular point. Tomorrow we are going to look at the statement of financial position, so you're going to understand what I mean by that better. So this is the structure. This is the structure. I'm going to take you through step by step. And the first one is to record sales. The sales. The sales is if you are a business dealing with buying and selling of laptops, the amount you've earned from selling those laptops is what that comes in here. Okay, is what that comes in here. And you can see from here we had 480. We had 480,000. Okay, so we come and write it here, 480,000. Remember, when you see a question where, or rather if you're working on something, always be keen on this when you're preparing statements. You can see here it's written, this is million basically. So I've included million here. So we are carrying this correct figure. Okay, if you want to write it in this format, don't forget to include this as well, so that the person who is reading this is able to understand. Always when we have the sales, the next thing we look at is the cost of sales. The cost of sales is the cost of goods that you have sold. Remember this laptop that you've bought, you paid some amount of money, so you get these laptops and then sell them. The moment we sell is when we recognize the cost of those goods that we have sold. So cost of sale is basically the same as cost of goods sold. You're going to see GAAP usually uses cost of goods sold. Mostly IFRS uses cost of sales, but it is the same. The cost of buying those goods that you have sold. If I went and bought laptops at 10 laptops at 10,000 each, okay, that is 100,000. Okay, this I'm going to record it as inventory. This is going to be inventory in the business. When I sell, I'm going to record now the sale. Let's say I sold them at 12,000. Okay, so 12,000 times 10, so I sold them at 120,000. Okay, this is the sales revenue. Okay, now what is the cost of goods sold? The cost of goods sold is this 100,000. It ceases to be inventory because now the inventory has gone to the client, but we need to recognize the expense of buying the goods. So now this is what we call the cost of sale or the cost of goods sold. Okay, this is going to be 100,000. Okay, hope you get up to that point. Just confirm if you understand, because now the first adjustment that I want us to look at is the cost of sales. Okay, the first adjustment, period end adjustment that we need to look at is the cost of sales, and this happens when we have a periodic inventory system. Okay, so when we are talking about when you're looking at a perpetual inventory system, you're going to find then there's going to be a balance already in the trial balance, because we pass a journal entry. The moment the sale happens, one of the journal entry is of recording the cost of sale. So you're going to see it is going to be listed in your TB. That is your trial balance. It's one of the balances you have already recorded, okay? Because the system is speaking from the journal entry, and just as you have purchases balance, you're going to have a cost of sale balance. That is when we have a perpetual inventory system. But when we are looking at a periodic inventory system, we do the adjustment at the end of the period, because at the end of the period, you are going to do a stock count, a physical stock count that is counting the stock. So we are able to know what is the opening balance. Opening balance as at January 2025, you're saying the laptops, let us use this example of laptops, okay? So this business deals with buying and selling laptops. The laptop stock that we have at the beginning of 1st January 2025 is worth 42,000, okay? So this is what we have at the beginning of the period. That is the opening balance. That is basically what we call opening balance. Okay, then we have the purchases. The purchases is what you've bought during the period. The purchases is what you've bought during the period. Those laptops that you've bought during the period, which are worth 240,000. Okay, So we usually add them. We want to know what are the purchases, what are the laptops we have during the year, what are the laptops we have during this period, okay? So we have the purchases, okay? Another thing I want you to note when we are looking at the inventory, we also bring in the carriage inwards of bringing this inventory. The carriage inwards. The carriage inwards is the cost you incur to go take these laptops and bring them to your warehouse. It is part of the cost of buying these goods. Okay, it is part of the cost of buying this inventory. Okay, and you need to cater for it. If you don't cater for it, remember you could be buying this laptop at 10,000 and then you are incurring a cost of 1,000 and then a client comes and tell you, I see you're selling this at 12,000, kindly give me a discount, I pay 11. Will you not be operating on a loss for refusing to look at this is just an example, for refusing to look at the carriage, the cost you've incurred to bring in this item. So you have to make sure the cost of bringing this inventory into your business is taken into account in the calculation of the cost of goods that you have sold, okay? So we have the carriage inwards, but remember there is an adjustment that you need to look at. We have the carriage inward is 8 million, but we were told that part of that carriage inward, 1.2 million relates to carriage inward of the furniture. So what we are saying is this 8 million is not what is carriage inward for bringing inventory alone. No, this is carriage inwards for also bringing in furniture, and we have 1.2. So to get for only, because we're only looking at cost of goods sold now, we are not looking at furniture. Furniture, remember, it's something you're buying not to sell, you're buying it to use in the business. You're going to see how this is going to work in the depreciation of furniture and also in the statement of financial position. You need to less this 8 million, you less this 1.2. You need to less 1.2 so that you are able to see what is the carriage inwards that is relating only to the inventory. Only to the inventory. What is 8 million less 1.2? What is 8 million? Sorry, let me see if you can see. Yeah, what is 8 million less 1.2? Someone to tell me. 8 million, you less 1.2, 6.8. Let me know if I have the correct figure. It's 6.8 million, right? Let me know if I have the correct figure. Okay, so we have to have now the carriage, you have to have the carriage inwards, and in this case the carriage inwards relating only to thank you Jane, only the carriage inward relating only to inventory, okay? Then what else do we need to look at? Remember, we have now the carriage inwards. We have in our additional information, we want to look at what else is affecting inventory. Inventory is the stock that you have bought to sell. Remember, inventory valued of 36 million is still remaining in the business. It is still remaining in the business. That means for all these, there is what is left you need to remove. We want only, remember when you are calculating this cost of goods sold, we want only to cater into the goods that we have sold. That is what we are trying to calculate here. The goods that we have sold. That is what we are trying to calculate here. So we took what was left in the warehouse at the beginning of the year. We have added what we have purchased during the year. We have also included the carriage inwards. Then we are going to less the closing balance. You're going to less the closing balance. Why are we lessing the closing balance? It is because these are the items that are still in our warehouse at the end of the period. It means we have not sold them. Okay. What is the other thing we need to less? What is the other need we need to less? Is we are told here, this is likely depreciation allowance included in the no. We are told goods costing 5 million were withdrawn by the proprietor for personal use. So let's say this proprietor has a place where they use these laptops, and they took the goods, they went to the warehouse and took these this laptop for their own usage. This is for their own personal usage. So you see, these were not dealt in the business. They were not dealt in the business. So then what we do is we need to less these as well. We need to less those drawings from there. This is a drawing actually. We need to less this drawing because now part of these goods, they didn't go to being sold, they went to this sole proprietor. So we have to less the drawings in this case, and the drawing is relating to the goods. We don't less just any other drawing. We're only looking at the drawings that are relating to the drawing of the goods, the inventory stock. Okay, so with that, how do we arrive at the cost of sales? What is our opening balance? What is our opening balance? So our opening balance was inventory of 42. Allow me to use without the other zeros, just as it is. That is 42 million. What were the purchases? The purchases we had during the period is 240. We have 240, so we add 240,000. Okay. Then what else do we add? We add the carriage inwards. But remember, the carriage inwards that we are adding here is only for we are only looking at a carriage inward that is relating to the inventory. So we left the 1.2, we got the 6.8. So we are talking about 6.8 million. Okay, then what else do we need to do? We need to less the closing balance. What is our closing balance? Our closing balance is 36. So we are going to less 36,000. Then what are we else going to less? What else have we forgotten? We need to less the drawings. The drawings was 5 million. The drawings was 5 million. Let me know what is the total. Let me know what is the total here. Let me know what is the total. We are taking 42. We add 240. Okay. Then we are going to add 6.8. Okay. Then we need to less 5 million, and also we need to less 1.2, which we have already less here. Okay. And then we need to less 36. Let me know. Okay, this is coming to 247. Just confirm once you get the total. 247. Remember, this is in millions. I'm just here. We all have a 0, 0, 0, 0. I'm just not including them. Okay. So, but when I'm recording here, I will have 247,800 here. 247,800. Remember, for you, the first section of the statement of profit or loss is usually you take the sales. Let's say the cost of selling these sales. Let me write in another color. The sales. Okay. You're going to less the cost of sales or the cost of goods sold, and then you're going to get what we call the gross profit. We get the gross profit. That is why here we are adding the bracket to show we are lessing so that we get the gross profit. So here we're going to get a gross profit of if you less this, what are we going to get? Anyone who has done that calculation? It should be 232,200. Okay, this is the first section. Let me know if we are together. Kindly confirm on YouTube. Let me know. Still can't see no chat. Just confirm if you understand, if you are together in this. For the people on TikTok, remember I'm streaming on YouTube. For the ones asking the question, I'm also sharing my question. I'm also sharing the question on YouTube. So just join. There's a link to my YouTube on my bio or on my TikTok stories. Just join the live session that is happening now. join the live session that is happening now, Accounting and Finance Playbook. Thank you so much, Jen. That is correct. So together, this is the first section. The first section is to calculate the gross profit. The gross profit, okay? Now let us go to the other section. The other section lists what we call other income. Remember, this is the main operating activity of this business, to buy and sell laptops, okay? So when we sell these laptops, we've collected 480, and then the cost of buying these laptops is 247. So when we are looking at a business that we want to know if this business is making profit, this is the profit they are having just from buying those laptops, okay, and selling them. So this is what they are getting. So the next section we look at is we list other incomes. We list other income. Other income that the business is getting what is other income that they are getting other than from their operating activities. Remember, one of the items I listed as I told you, I looked at in the previous live, is discount received. What did I say about discount received? Discount received is basically an income, because if you do not pay that, for example, the supplier, by that period they have asked you, if they invoiced you 10,000, you will have to pay them 10,000. But if you pay them before, because the cost of what they have sold to you is worth 10,000, you're only getting a discount. But when please see the difference here. When you walk into a business, like right now, are walking and you find some goods is being sold at 10,000, you tell them, no, you see, sell me at 9,500, right? And they give you that discount there, and you pay them there, then that is not a discount received. A discount received comes in when we have that condition. When we have that condition where your invoice clearly reads 10,000, you're only going to get that 5% discount, for example, only when you pay early. Now that is what we call a discount received, and it's a form of income to the business, okay? This is because I know here we have other income that we have is this discount received. Now this is where we come and add it. And the reason why we have it here, discount received, is because we remember, you're going to understand this, because when the client invoices you that 10 million, when you are recording it, you are going to debit account, sorry, not debit. You have received the goods. Yes, you have received the goods from the client. So you debit inventory to show that you have received from the supplier. You're going to debit 10,000, and you're going to credit account payable of 10,000, okay? But then when you go to pay, because you've paid early, you're going to debit account payable an amount of, let's say now the discount that you've been given is only 500. So you're going to pay 9,500. Sorry, you may not be seeing this. Sorry. I see this is hidden now. Just a second. So I'm saying, so I'm trying to explain to you. I'm trying to get, yes, Harmon, before we proceed, yes, you can get a negative. That from that point, that shows that business is not managing their costs, and not even their costs. They are not doing a business there. Something is wrong. You're selling below. Maybe you want to close, okay? It can happen if you are just trying to clear your stock. You want to close the business, okay? Now, let me take you back to what I was explaining here. So we are saying you went and debited inventory. Okay, I want to explain to you the journal entries here. You debited inventory of 10. You received goods of 10,000, and you credited account payable to recognize that liability that you're going to pay this client 10,000. But then you go and pay earlier, so you get let's say, for example, 500. Okay, I want to explain to you how discount received works. So when you do that, you pass this journal entry. Now you've paid, and you're paying early. So you come and debit account payable to reduce it. But now you've only paid You've only paid 9,500, and then you're going to credit. You're going to credit what? You are going to credit not inventory, cash account, because now you've paid cash an amount of 9,500. So where do you record the other 500? Where do you record the other 500? Where do you record the other 500? Now the other 500 is now what becomes discount received, okay? This is now that becomes discount received because now you also have to record it, okay? And that is what now I'm saying is becomes your other, is an example of other income. Could be the other forms of, depending on what the business is doing, the other forms of other incomes, okay? Which you're going to look at as we look at more and more examples. If you join the live sessions weekly, you're just going to see we're going to make the questions harder and harder so we are able to cater into more and more incomes that could arise. So as at this point, what is our total income? What is our total income? What is our total income? Our total income is, you need to add this 232 and now the 7,000, because now we have another income of 7,000. It is going to be 239. Just a second. 239,200, okay? 239,200. Then that takes us to the next section. Let me actually use a different color, which is expenses. Let me actually indicate here clearly, we less expenses. Okay? We less expenses. And the expense, you're going to start with salaries. Here we have salaries and wages. We have salaries and wages. Let me know if we are together. Oh, nice. Okay, that's good. Now we go to the next section, which is expenses. And we usually take our income, we less our expenses so that we know, remember, we know if we gotten profit or loss, okay? So let us start. This is where the expenses start. And basically we actually have this, and you're going to see also depreciation is going to come in. So we have salaries and wages. We have a balance of 54,000, okay? Then when we look at our additional information, we are told that salaries and wages accrued amounted to 6 million. But the balance, that is what have been paid up to this point, is 54,000. What is our expense during the period? What is our expense during the period? Let me know. Let me get an answer in the chat. For the people on TikTok, I'm streaming on YouTube. There's a link to my YouTube account. For the people on YouTube, I'm asking, for the amount that you've paid for salaries and wages at the end of the period, this is the balance, okay? But you are told that salaries and wages accrued amounted to 6 million. So what is the expenses that we have incurred during this period? What is the expenses that we have incurred during this period? Let me get an answer. What do you do? What do you do? What do you do here? Let me know. Just chat in there. But remember, let me give you a clue, okay? Let me give you a clue. The clue is that basically, if the accrued amount, what do we accrue? An accrued expense has already been incurred. In accrual accounting, we recognize expenses when they have been incurred, even if you have not paid. The thing is, this person, yes, shows the balance entire. Harmon, in this case, for this example, they were showing the balance. Good. Thank you. That is correct, Harmon. So the balance here that we have of 54 is the balance that has been paid of salaries and wages, okay? But we are told we have 6 million that was accrued. So if you want to know the expense that has been incurred, the expense that has been incurred, we take 54,000, okay? We add the 6 million. 50,000 million, we add the 6 million, okay? And we are going to get 60 million, okay? We are going to get 60 million. Why? Because this has been incurred. It's just that it has not been paid, okay? So here we are going to have the first expense, which is salaries salaries and wages. Salaries and wages, which is 60,000 here, but remember this is in millions. Yes, then is we take the 54, maybe it's that figures are not clear. We take 54, let's use our worksheet, we take 54, and then we add 60, it was 6 million, right? I've started confusing the millions. Let me just do this. Then we had 6 million, okay? So this is basically 60 million, okay? That is the expense that we're going to less here, salaries and wages. Hope you're together now, Jen. Then, what is the next expense? We have lighting and heating. Lighting and heating, there is a balance of 12. This is what has been paid for, 12,000. What has been paid for during as at 31st December 2025 is 12,000. But then in the additional information, we've been told lighting and heating prepaid amounted to 2 million. Considering what I explained earlier, how do we go about this? What do we go about it? What is the lighting? What is the lighting and heating expense that we should be deducting in our profit and loss? Kindly comment there. So the balance is, we are told here, is what has been paid is 12,000. What has been paid is 12,000. But part of it, we are told that this has been prepaid, which is 2 million. 2 million is prepaid. So what is the expense? What is the expense that we should be writing in our statement of profit or loss? Harmon, why? Remember these asset 31st December 2025. This is what we paid for lighting and heating, and part of it, in it, this 2,000, this 2,000 is prepaid. So meaning this will go to the next period, which is 2026. Yes, thank you. That is 10,000. Why? Because the 2,000 is part of this 12,000, but it is not going to be utilized in this period. It is going not to be utilized in this period. Jane? No, we need to understand this, okay? We need to understand this. Let me repeat again. Yes, we subtract. Why? Because this is what happens. Let's say, for example, you go, let's work with insurance. For example, let's work with insurance. I went and in November, I bought insurance of 120 that is going to cover the period. Actually, let's say I bought it in October. That is going to cover the period from November all the way to October 2026. This is 2025. This is the period that this insurance should cover. That is 12 months, November, December, January, February, March, April, May, June, July, August, September, October. That is from November 2025 to October 2026. And I'm preparing the financial statement as at 31st December 2025. Okay? Remember, I paid the insurance 120,000. And as at 31st December 2025, I've only utilized this 120 for only the month of November 2025 and December 2025. And the amount that I've utilized is basically, you take this 120,000, you divide it by the number of coverage. The coverage is from November to October 2026, which is 12 months. Which is what? 12 months. So we have 10,000 each month. So I'm only going to expense, at the end of each month, I expense 10,000. Okay. Then at the end of December, I'm going to expense another 10,000. So as at 31st December 2025, I am only going to record an expense of 20,000. And the other amount, which is 100, that is going to the period 2026, is going to be recorded. That is 100,000 is going to be recorded as a prepaid, as a prepaid as a, oops, just a second here, as a prepaid insurance. Prepaid insurance, and this is basically an asset. It is basically a current asset to the business, okay? So basically, when expensing, I'm only going to expense 20,000, then 100,000 is going to be recognized as an asset. So this is the same thing that is happening here for lighting and heating. We are saying I paid 12,000 million, okay? But then we are saying that lighting and heating amounted to, heating prepaid amounted to 2 million. So what is prepaid already, what is prepaid only is 2 million. So what I'm going to expense is 10,000. And then in the statement of financial position, 2 million is going to be prepaid insurance. It's going to be a current, prepaid expense. It's going to be a current asset, okay? So in this case, we're only going to expense 10 million. So the lighting and heating that I have incurred, spent, is going to be 10,000. So I'm going to be lessing 10,000, okay? I'm going to be lessing 10,000. So what is the other expense? What is the other expense? We have general expense. We have general expense. For general expense, let me reduce these. So general expense, what is the additional information? The general expense, we are told that included in the general expense is 3 million relating to proprietor's personal expense. What does that tell us? We need to remove that because that is not a business operation. This is personal. So 18 million, we need to less what? We need to less these 18,000. Yes, 18 million, sorry. 18 million, we need to less this 3 million. We need to less 3 million. So what does that give us? Just comment there. What does that give us? How much should we be deducting? Here, that is for general expenses. In our statement of profit or loss, we should have 15, okay? We are taking the 18, we less 3, we get 15, okay? So, then what is the other expense? What is the other expense? Here we can see after that we have bank is balance, drawings, capital, sales, trade payables. We're going to see these are going to be applicable in the statement of financial position. Thank you, Hamon. So what is the other thing you should be aware? Even before you check the balances alone, you need to look at your additional information. Another adjustment that is made is usually for depreciation and for allowance for credit losses. So what is our depreciation that we need to expense this year? We are told that depreciation on furniture is provided at 10% per annum. You're going to see the assets that we have, the non-current asset. The non-current asset is the premises, which premises could be land, and it doesn't have to depreciate. You see, it's not included as depreciated, then we don't have to look at that depreciation. But we have been told that furniture, we have 90%. Okay, this is the net book value. If it's not the net book value, you would be told the furniture was bought. Actually, what is happening here is this furniture was bought during the period, because then we are talking about the carriage inwards of 1.2. That means it was bought this year, 2025. Jacqueline, why 3 million deducted from 18 million? Because general expense is 3 million relating to proprietor personal expense. We don't include the personal expenses with business expense. Whenever such happens, that's a drawing. When the sole proprietorship is when you are running the business as one person, okay? You can sometimes pick money from the business. You need to make sure you record that you have taken it. So that is why we are taking out these 3 million, because we are preparing, we do not mix business operations and personal operations, okay? That is why we are taking the 18, okay? The 18, which is the general expense, that is inclusive of this 3 million relating to the personal expenses. Okay, hope you are together. Now let us go back to the depreciation. We are told on furniture is provided at 10% per annum. 10% per annum. And the furniture has a cost of, so here we're talking about the furniture. The cost of buying the furniture, is 90,000. Okay. Another thing that we need to include in the cost of buying the furniture is the cost of bringing in this furniture into the business. Okay. And that is what we call in the carriage inwards that you were given in the additional information, that 1.2 million is the carriage on furniture. So what we are going to do here is we are going to add 1.2 and we are going to get the cost of buying this furniture as 91,200,000. Okay, 91,200,000. So this is the cost of furniture, and the depreciation expense that we need to recognize in this period is 10%, because we've been told 10% per annum. Okay, so here we're going to have 10% of 91,200, which is going to give us 91,20. Okay, 91,20 as the depreciation. Yes, thank you, Hamon. You are right. 91,20. Okay, 91,20. So basically, what do we do here? We come and less now depreciation. We come and less depreciation on furniture. Remember the expenses, we usually less them. Okay, we usually less them. So you less 91,20. Okay, remember this is in millions. It's indicated there. Then what is the other expense? Allowance for expected credit losses. Allowance for expected credit losses. Okay, this is basically the same as bad debt or doubtful debt. Okay, same as bad debt or doubtful debt. We've been told that is maintained at 5% of trade receivables. 5% of trade receivables. What is our trade receivables? Is 60,000. So we have trade receivables of 60,000. So what do? We take 5%. We are saying basically 5% of this 60,000 might not be paid. Okay, may not be paid. We've seen our client, we've seen like normally in the previous years, these people don't pay. So we are saying we may not collect, out of this 60,000, we may not collect 3,000. Okay, so at the end of the period, we do an allowance, we expense it. It is an expense to the business, because we are saying it's like we sold goods and someone is not going to pay. So we are expensing it very early, because we've seen there's a track record of this amount not being collected. And also in our financial position, we are going to reduce the trade receivables to 60,000. Okay, we less the allowance that you've put in there. Okay, and if there are previous allowances that we've made, we also need to cater into them. I'm going to show you what we do when in the next tomorrow when you're looking at the statement of financial position. Now we are looking at the statement of profit loss. We have to expense this 3,000. Okay, so here we have to come and less this 3,000. Okay, so you come here, right? I'll usually call it bad debt expense, or you can call it. Just make sure you're clear and you differentiate it from what we reduce our contra asset account. Okay, I'm going to talk about that tomorrow. So here you come and write allowance for credit losses. We less 3,000. Okay, so what else have we left out? Any other expense? If there is no any other, we just come here and say what is our total expenses and sum these. You can just go through here and see what is it that you have left. We've catered to inventory, salaries, lighting, depreciation, allowance, the general expense. We took the goods that were taken by the proprietor, and the carriage inwards we've catered into. Okay, So what is our total expenses? What is our total expenses? Let me know what is our total. Just chat it there. The people on TikTok, remember I'm streaming on YouTube. Let me know. Thank you, Stephen. Thank you, Stephen. Thank you so much. Tomorrow we're going to be here exactly at 8 p.m. Exactly at 8 p.m. So basically the total of 8 p.m. East African time. So the total expenses is going to be 97 120. So the next question I'm going to ask is, what is going to be our profit? What is going to be our profit for the year? What is going to be our profit for the year? Charlie? Yeah, what's going, let me, as you do it, what is going to be our profit for the year? Remember, you're taking the total income, you less what? You less your expenses, okay? So, what is going to be our profit for the year? What is going to be our profit for the year? It is basically going to be the total income, okay? You less your total expenses, and you are going to get 148,80,000, 142,080,000, 142,080,000. So that is how basically you actually prepare the statement of profit or loss for a sole proprietor. Because for the sole proprietor, you're going to see we don't include much here on taxation, because a sole proprietor, you're going to be taxed at the end together with your personal expenses. So as of this particular point, this is what is going to be the profit for the year. Then this profit, when you're counting it in your personal PAT, that is your income, your PIN number, your PIN tax number, you're also going to remit the taxes for other things that you could be doing aside, okay? Okay, let me see. Now I need the questions to come in. Yes, thank you, Jane. That's correct. That is correct. Now is the time to ask the questions. For the people on YouTube, for you not to be missing the streams, kindly take your time. Go subscribe to the account now. Okay, go subscribe to the account. For the people on YouTube, ask me the questions. Ask me the questions. Keep them coming. Keep them coming. Now is the time. I would, after this, I would recommend to you, if there's anything you missed, go look at all the period end adjustments. All these, I've done specific videos for them. For cost of sales, I've also done specific videos for them. So now here is just understanding how we prepare this, the statement of financial position, okay? The statement of financial position. So actually for Hamon, I'm going to do a video for a manufacturing account. Okay, actually now one of the sessions, I intend to include also a video for manufacturing and also for partners. I'm going to do one for manufacturing and for partners. Yeah. Errors, I'm handling errors on Saturday, suspense and correction, where I have the suspense account and correction of errors. You're going to do it on Saturday, 12 p.m. 12 p.m. Keep the questions coming. Keep the questions coming. Any question that I didn't address, if you asked a question in the other stream that we dropped off, just ask me again kindly. The persons on TikTok, you're missing out because you are not yet subscribed to the account. That is why you might have missed the session. Okay, okay, Hamon. Stephen, I hope I've answered. Yes, the recordings are, I'm going to post them here on YouTube. All the recordings are going to have them here on YouTube, okay? This one, also yesterday we look at the bank reconciliation statement. After this, you're going to see the recording here on YouTube. All the recordings, I post them here on YouTube. Feel free to visit after this. After this, you're going to get them. Let me know, or I start asking questions. What do you do? Do you include a prepaid expense in the statement of profit or loss? Do you include a prepaid expense in the profit or loss statement? Just starting there. Do we include a prepaid expense in the profit or loss as part of the expense? Also, the people on TikTok, you can answer to that. Do we include the prepaid expense in our profit and loss as one of the expenses? Just chatting there. Just chatting there. Let me know. Okay, Newton, noted. Chatting there. Do we include prepaid expenses? Do we include prepaid expenses as part of our expense in the profit or loss? No. Why? Why don't we? Yes, no. Thank you, Stephen. Thank you, Hammond. That is correct. Why? Why? Because it has not yet been incurred. In accrual accounting, we only recognize revenue when it has been earned, and we recognize expense when they have been incurred. So let me ask the second question. If you have been paid by a client as of right now, good, yes, it is an asset. If you have been paid by a client, thank you, Rose, thank you, Newton, that is correct. That is correct from TikTok. Keep liking the live. So we are saying it is an asset. A prepaid expense is a current asset. It is recorded in the statement of financial position. Another question I'm going to ask is, if you go and get you are paid for some cups that you're yet to deliver, how do you record that? I have entrusted you, I've seen your business. I tell you, take this amount of money, go, you're going to deliver to me these cups. You're yet to deliver. What do we call that? What do we call it? I have paid you cash money. You are yet to deliver. Maybe you are yet to get the stock to deliver. Well, how will you record it? And are you going to include it as part of your sales? Are you going to include it as part of your sales? Let me know. Answer on TikTok and on YouTube. Keep liking the live. Keep liking the live. Keep liking the live. Other people get notified. Other people get to as well benefit from this when they join. Let me know. I'm asking, I have paid you, let's say 1 million for you to deliver some goodies to me, but you are yet to deliver as a business. How will you record that as a business? Accruals, okay. Let's continue. What else? Accruals, what has been accrued there? Continue. I am still looking for something. Oh, nice. From TikTok, I can see Lindsay, correct. Lindsay, correct. Correct. Keep liking the live. Keep liking the live. Basically, when you go and at the point that you've not delivered, that is a liability to the business because you have not yet done your part of delivering these goods to me as a customer who has paid. You record this as deferred revenue. You record it as deferred revenue, and it is a liability to the business because you are yet to deliver what I have paid for. I have the right to come and ask you for that money because you've not delivered. Okay? So this is what we call deferred revenue, and deferred revenue is revenue that has not been earned. It is also known as unearned revenue. Unearned revenue. Revenue that you've not earned. So in accrual accounting, I said we recognize, thank you, yes, Palma, correct. Newton, yes, Newton, that is correct. Keep liking the live. Yes, keep liking the live. So we are saying in accrual accounting, we recognize revenue when it is earned, meaning you've done your part. That is why if you came and delivered the goods to me, and I am the one who is yet to pay, that business should record that as a revenue, should recognize the revenue as at that point, even if they have not been paid. That is why we have trade receivables. We have delivered to you, but you've not paid. In accrual accounting, we recognize that as revenue earned because you've done our part. But if we have paid, a client has paid the business and they are yet to do their part, that is what we call deferred revenue or unearned revenue, and it is recognized as a liability. It is a liability to the business, and it is not going to form part of sale, because you can't recognize a sale if you are yet to deliver those goods that you are supposed to deliver. Let me know if that is clear. Jane, and Stephen, just commenting there. MF, current liability. Palma, debit, cash, bank. Okay. Now I want you to ask questions. Keep liking the live. I'm gonna ask another question. Nice, Jacqueline. Nice to hear. I'm going to ask you another question. Basically, what does depreciation mean? What does depreciation mean? What is depreciation, and why is a business doing depreciation? Why do we need to do depreciation, and when do we do depreciation? MF, nice. Keep liking the live. 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 Let me know why. Okay, Lindsay, I can see loss of value. Loss of value. Jane, welcome as well. Why do we do depreciation? Lindsay, impairment of assets due to continuous use. Okay, we could put it like that. Again, why do we do depreciation? Why do we do depreciation? Okay, these are Henry, depreciation means decrease in value if fixed asset due to wear and tear. By fixed asset, we're talking about PPE. Yeah, it's the same. But Henry Palmer, what you said is basically what brings about depreciation. But why do we do it? I can see here, Newton, you're saying spread the cost of an asset over its useful life. That is correct. Spread the cost of an asset over its useful life. Yes, there's a difference between depreciation versus amortization. Amortization happens mostly it's for intangible assets. Okay, Lindsay, to arrive at net value of the asset. That's okay. There is one thing I would like you to differentiate. An asset is, you're all correct actually. An asset, let's say when you buy a motor vehicle like today, there is wear and tear. As you said, Palma, there is that. It's going to depreciate. The cost of it is going to depreciate, wear and tear. There is also impairment. There's some technology that can come in and it makes what you had. Let's say like what happens to the typewriters when computers came. You see, just random impairments. But now why we take this motor vehicle, and we say this motor vehicle we bought it at 5 million, for example, okay? If we go this year that we bought this motor vehicle and come and include that the cost, because it is an expense, we come here and include here motor vehicle cost of 5 million. It is going to have a very big impact to your financial to your financials for that year. Yet this motor vehicle is something that you're going to use probably for the next 5 years very nicely. Okay, yes, impairment is not the same as depreciation. That is correct. Impairment comes randomly. It can be caused by either like it has reasons of impairments depending on what is happening in the economy. Something has come up. Okay, it's different from what we refer to as depreciation as well, but they are almost related. Okay, so I'm saying when you come and record that there's an expense of 5 million in this year, yet this motor vehicle you're going to use it for a useful good life of like 5 years, then you might even find you're making a loss, because in the next year you're still using this motor vehicle to generate a revenue. You're using it to do your business. So what we do is we take this 5 million through depreciating. We go in the first year, we say 2% of. You're going to see that 2% of 5 million, okay, we get the amount. So we reduce the value, the net book value of this asset will be now the 5 million less the 2% of it. So next year maybe we are looking at 4.5. So we are saying 2% of 4.5. So we are going to reduce this. We are going to expense this vehicle over a certain period of time, because this vehicle is being used, it's going to be used over that period. And another thing you should know is we expense something when it has been used to generate revenue. If you expense it in the first year, you're not using the motor vehicle entirely, only this first year that you bought it. You're going to use it in the second year as well, and to generate revenue. And we expense something as it is being used to generate revenue. That is why depreciation comes in, okay? That is why depreciation comes in. Keep liking the live. Keep liking the live. I hope people from YouTube, you got that. I hope you got that. Just chatting there. Remember, we recognize expenses in the same revenue, in the same period that they have generated revenue. That is a statement you should know. It is called the matching concept. We have accrual accounting that also we follow the matching concept. The two marry each other together, okay? So we are saying in the period that we have generated this revenue, this sales of 480, we are also going to recognize the expenses that have been incurred in the same period to come about this revenue, okay? And we are saying now, if you come and expense this 5 million in the first year, in the second year, you're not going to use that motor vehicle to generate revenue. You're going to use it. So what will you expense in the next period? That is why now depreciation comes in, and it is also backed by the fact that a fixed asset loses its value through wear and tear. So the first year, the more you're going to realize, because the cost is higher, it depreciates more. As you continue, it depreciates less, depending on which method you use. There's a straight line where the depreciation is the same every year. There are many ways to depreciate. It's just a matter of deciding which one is better, depending on what you're dealing with, okay? Model, we are streaming on YouTube. There's a link. There's a YouTube. Check my YouTube. There's a link on the bio. There's a link on the stories. Go to my YouTube account. Subscribe. Every time we start a live session, you will know. The people on YouTube, please, on TikTok, I don't want you to be missing these sessions. And then after is when we are finishing the classes, when you get to know where we are. I usually post on the TikTok. the TikTok stories. There's a link there. Go to YouTube, subscribe. Even the people on YouTube, I hope you have subscribed. And if you have any question, keep asking. Then I'm going to ask another question. I am going to ask another question. Lizzie, I'm coming there. What is the reason behind getting the allowance for expected credit losses, that is doubtful debt or bad debt? I like when someone tries, keep trying. Even when you don't get it, if there's something in life, I know is when you try something, when you try something and you fail, you never forget. So you're going to learn better. So what is behind, why do we have to get the allowance for expected credit losses? Lindsay is asking, explain materiality concept. Materiality concept is basically as simple as this. If you go and see a bank that is listed, that is making a profit of probably 250 million in a year, and their numbers, you see an error of 1 shilling, is you ask yourself, should you sue them because of 1 million 1 shilling in their statements, in their financial statements? Should you be worried because of 1 shilling? Lindsay, I hope you understand where I'm arriving at. Would it bother you that 1 shilling has been missed in their statement? No, it shouldn't bother you, because you look at the amount of money depending on your operations, that is not material. Yes, Lindsay, that is basically what is materiality concept. And you're going to see it's applied when by the internal accountant is looking at, this thing is we call it immaterial. You can't sit down and say you can accurately prepare something to the letter, because we have decimal places and everything. It's just we create a materiality depending on the operations and what is at risk. This you're going to see also the auditor. So the audit is also the external auditor is going to create a materiality and a performance materiality as well. I think I'll have a day for teaching audit. Okay. Thank you, Jenny. That is okay. So liability to the company. Yes, Tiffin, I can see comment to not overstate profit. I asked the question, that is correct. I asked the question, why do we have allowance for expected credit losses? Thank you, Lindsay. Keep liking the live, guys. Keep liking the live so that others join. Henry, you're saying allowance for doubtful debts occur when we are sure that 50% of the debtors will not pay. Is that the case? Is there a mapping for 50%? Let me see comments on that. Is it indicated that 50%? I would like to know this. Is that the case? Because it doesn't have to be 50%, okay? I don't think so it has to be 50%. Yes, I can see another comment. Let me know. The probability to avoid shocks in the P&L when debts become bad. Okay, yes, allowance used to write off the bad debts occurred. Yes, I'm not sure. Maybe Henry, you can, or the probability, maybe the probability, but we are not capped. Actually, 50% to a bank, 50%. If a bank notices even 10%, even a 1% to the bank, one debtor, one person in the bank who has a very massive loan, and yes, has a very massive loan, they need to report it. So that capping, I don't think so it is there. Maybe if you have a specific place you can reference us to, like you can reference to it. But basically, as per IFRS, for a financial institutions, you have to just have that allowance for expected credit losses, okay? And it comes about when you look in your previous years, you see that this percentage of people trade receivables are not paid. So you create this allowance to make sure you've not overstated your profit. You've also not overstated your assets, okay? And yes, Jane, that is correct, ensuring that business reports an honest and accurate picture of its true net income as well as the assets. That is correct. Let me see from TikTok. Allowance to write off. And then in the next period, you're going to write off those bad debts once they are confirmed. You're going to write off alongside that allowance that you've created. There are many videos I've done on allowance and how you write off now when you have an allowance, how you write off bad debts. Remember, you are writing off against that allowance that you've created. So this 3,000 that you have created, that by making sure you expense it, and by reducing your trade receivables, in the next year, when you have a bad debt, you come and reduce it from your allowance. Okay, you come reduce it from your allowance. And at the end of the year, now you have to make sure you do the percentage again on your trade receivables. You see what you need to add in your allowance account. Okay, there are many videos I've done on that. For the people who are joining, remember, make sure you subscribe to the YouTube account so that you don't miss our streams. Subscribe. Let me know the people on YouTube. I hope you've already done that. You've already done that. Let me ask you another question. Let me ask another question that is common in here. What is the other? What then we've looked at? Let me know the difference between discount received and discount allowed. Discount received and discount allowed. Let me know the difference between discount received and discount allowed. And also the difference that is bringing out the aspect of trade discount, and now discount received and discount allowed. Henry, correct. Discount received is the income. That is correct. Henry, I hope you are also on YouTube. Discount received is income. Correct. Keep liking the live, guys. Keep liking the live. Benefits others. On YouTube, let me know. I'm on. I believe this was the answer to the previous question. Okay. I'm asking, what is discount received? Yes, discount received is income and discount allowed is expense. Correct, Amon. Correct, Henry. And discount received is what you've gotten because you've received, you have done your bit, okay? You've paid before. And then discount allowed is that person that has given you this discount, so they have to record it as an expense in their statement of profit or loss. And then for you that you have received, what do? You record as income. You record as income. Okay? You record as income. Now, let me get the questions from you. Anybody? Discount received is one given to business and allowed is given by business to the customer. That is correct. Lindsay, discount received is income while discount allowed is an expense. That is correct. Discount received is from suppliers. Then discount allowed is to customers. Oh, correct. Yes, that is correct. So what happens to the allowance if all credit customers pay? Good question, Luneta. That's a good question. You see, so in this period, for example, the example we were looking at, we made an allowance of 3 3,000, right? 3,000 in our allowance for expected credit losses. In the next period, this is going to remain in our account. It's going to remain in the allowance for credit losses, which is 3,000 here. We're going to have it because it's a contra asset. It's going to be reducing the trade receivables. In the next period, if we look at our trade receivables and we see they have increased, we have, let's say, 60,000, okay? 60,000 receivables as at the end of the period. Let's say the same amount. But now we've seen our track record has gotten better. Last year we made an allowance of 3,000, but actually all of them paid. So we can decide, okay, but the reason why we came to the point of having 5%, it is because there are some people who had not paid in the previous. So we have to look at this statistically. So we can say, let's reduce from now 5% and bring it to 2%, okay, this year. So we are going to have, let's say, an allowance, we require an allowance of 12. This is 1,200, yeah, 1,200. So what we can do is, because we have this allowance of 3,000, that is above what we are required to have at the end of the period. We can just have this allowance. You don't have to bring it up. So basically, as at the end of that period, we still have the allowance that is required. So this provision is going to remain, okay? We're not going to continue it, because if this client, if a client doesn't pay, we usually come on this side, we less. Let's say they didn't pay 2,000. So our allowance that is remaining is 1,000, okay? So at the end of the year, we are like, okay, so let us see the allowance we should make during this period. So we do another 5%, we find we have to have 3,000. So we don't come here and expense 3,000, we expense 2,000. We only do 2,000 so that we have, at the end, we have 3,000. I hope that makes sense. I hope that you understand that, Luneta. This account is going to remain there just to create that allowance for us. And we are going to write off the bad debts on this side, but we make sure at the end of the period, we still have that allowance that is going to cater to our trade receivables as long as we have them. Hamon, what do you do when you have only opening inventory? What do you mean by that? Then you will not, in accounting, you really need to have enough additional information to make a judgment. That is why when you ask me a question, I would really love to know more so that I'm able to expound, okay? Because you cannot give me only opening balance for inventory. I don't know the purchases, I don't know the closing inventory, okay? That one is not going to help me to calculate the cost of sales. Maybe if the TB already has the cost of sales directly. So Lindsay, you said you explained discount received based on payment before the credit period. What of cash discount? Cash discount is when, as at that particular point, you have negotiated and there is no condition. Is basically you found that the thing was being listed at 10,000. You told them, I only have 9,500, take it. You pay and you take your product. So these goods, as at this particular point, they are worth 9,500, okay? That is basically a cash discount or a trade discount, okay? You've negotiated there. Yes, you can ask question about the accounting equation. The accounting equation is the assets in a business is equals to liability plus capital. This is that rule that you should know in accounting, okay? That rule that you should know in accounting. That's the rule that you should know in accounting. So we are asking clarifying on return inward and outward treatment. So there is usually what we call sales return. And there is what we call purchase returns. So what is happening here? Purchase return is when your supplier gives you something that is horrible, you have to return. Then Sales return is when you sell something to your client and it's horrible, they have to return. So in your sales, in calculation of sales, you should less sales return. If there's a sales return, you should say less the sales return. It means this thing has been you've brought it back. So when a client returns something, they ask for the refund, and if they are not yet paid, basically you need not to record this sale because now they have returned. If it is the purchase return, if you had paid, then you need to less it from their purchases because now you have returned and the supplier has returned you, has refunded you. Okay, that is what you're basically called sales return and purchase return. So in our statement here, if we had a return, a sales return, we should have taken the sales and deducted sales return. Okay, and in our calculation of cost of sales, we should have also less. Here, when you look at the purchases, we need to less the purchase returns. That is if you had any purchase returns, okay? For the people on TikTok, remember I am streaming on YouTube. For you not to miss the classes, just go subscribe on YouTube. Debit note, credit note. Yes. Toby, yes, I'm coming back to you, Henry. Want to start your CPA? You can. It's the best time. You can multitask. You just take a few units at a time. Did I miss any further question? Lindsay, I'm going to do, I decided I'm going to do a schedule that is at least covering a month. I usually do for weekly, but I'm thinking I'll have one for the month. So that then you can know which days you are doing taxation, which days you're doing auditing and management accounting, okay? Which other question? My YouTube name is Accounting and Finance Playbook. There's a link on my TikTok story. Stephen, just comment if you got my answer on purchase returns. Return inward is basically your sales return because you sold to your client has returned. Outward treatment is when the business, you're returning to your supplier. That is your purchase return. Let me know if I've answered your question. Then Bawok, make sure thank you, Jenny. Thank you, Mama Princess. Go to the YouTube account, subscribe. I think I started here on TikTok, got a lot of support. I opened the YouTube, but the YouTube is the best platform for what I do because I am able to share my screen better here. I'm also able to make long form videos. I like to prepare videos that anyone can learn from at the beginning level to intermediate level to an advanced level without feeling like they are losing anything in between there. Because once you understand the process, when presented a scenario, you will be able to think through it and solve it, okay? Bawag, let me know once you're able to get the YouTube page. Nice, Stephen. Let me know once you're able to get the YouTube page. Let me know. Keep liking the live, guys. Keep liking the live. Double tap on the like. Double tap both on YouTube and TikTok, please. As you keep asking the questions so that now we can end in a few minutes. Remember tomorrow, statement of financial position. Statement of financial position. Guys, double tap the live. Double tap the live on both TikTok and YouTube. I want us to end in the next 10 minutes. Now, this is the time to ask the questions. Ask them. Tomorrow, we are looking at the statement of financial position. We are looking at the statement of financial position. Statement of financial position. Statement of financial position exactly at 8 p.m. Anybody struggling to get the YouTube account, there's a link on my bio. There's a link on my TikTok story. There's a link on my TikTok story. There's a link on my TikTok story. I'm trying to multitask both here. Any questions? Let me know for the people who are streaming on YouTube. People streaming on YouTube. Keep liking the live as we close. Let me know for the ones who are joining. Make sure you subscribe. We're finishing up this session. You're going to see the pre-recorded videos for yesterday, that is bank reconciliation statement and the statement of profit or loss. I'm going to post it here. And there's the many topics we've looked at. You're going to see many videos on YouTube as well. And if you want a structured course, there's a link on all my socials on Facebook, on TikTok, and on YouTube. I am on those 3 platforms. Keep liking the live. Henry, you said you talked about allowance for credit loss. Assume today I have an allowance for 10, but it increases. So usually do this at the period end, okay? So we are saying for this period, these are the trade receivables. We are doing this allowance. We look statistically, what is the rate at which we are writing off these bad debts? We create an allowance that is similar to what we are writing off in a year. Let's say we are looking at the period of 1 year. And then now in the next period, we write off the bad debts against this allowance. If we finish it, then at the end of the year, we look at the trade receivables we have, we create an allowance that is going to subset that bad debts that we've written off, and that is going to cater off to the trade receivables that you're carrying to the next period, okay? There's, I think I've done like 3 videos or 4 on allowance for bad debts, because I know many students struggle with that, and also practicing. Okay, most people practicing, they have issues with that. I've done quite a number of videos on that. You can check them on YouTube. I hope I've answered your question. So let me know if you're able to subscribe, the ones on YouTube. Anytime, Henry. Let me know if you're able to subscribe. For the ones on YouTube, I'm waiting for you in case you have any question. Now is the time to chat before we end the live. You can chat if you have any question. How do you treat bad debts written off? Depends. There are 2 ways to write off bad debts. Number 1 is the direct writing off of the bad debts. And the second is what we are calling the allowance or provision, having that allowance. So normally it is the same, but now when you have an allowance and you come to write off this bad debt, you have to write it off against the allowance that you have created, okay? So for example, you come and debit bad debt expense, because now it is an expense because this person is not going to pay. And we do what? Once you debit the bad debt, you're recognizing the expense, and now you need to credit the account receivable. You need to credit the account or trade receivables or account receivables, because now we are reducing the expectation of receiving these goods. I mean of receiving this amount of money because you supplied this, okay? So that is how we write a direct bad debts. When it comes to when we are using the allowance, because you've already created this allowance at the end of a period, we come and because usually on the contra asset, you still have to debit the bad debt expense. You still have to debit the bad debt expense, but now you need to reduce. I'm used to writing when I'm doing this. So you need to recognize the bad debt expense, and you need to reduce. You need to reduce your allowance that you have created. When you're using allowance for expected credit loss, don't call it bad debt expense. I'd prefer you write allowance credit losses. Allowance for credit losses. Lindsay, there's some videos as well here on YouTube that you can refer to. Today we are looked at how we look at this allowance for expected credit losses under a statement of profit loss. now profit or loss. Now you need to know how we treat it in the statement of financial position. Luneta, the time we are looking at tomorrow is 8 p.m. We are looking at the statement of financial position. So for the people who are on YouTube, just go and subscribe so that you don't miss it. And then Stephen, you're saying first add me other more income added on gross profit. Not on the gross profit, but after. Remember, on gross profit, we're only looking at the sales less the cost of sales. That gives you the gross profit. Now, I think your question you're asking the other incomes that a business could have. You could have rentals. A business could have rentals. It's not their main business model, but they just add some extra and they add rentals. Then they are going to include that as other income. When you look at banks, they have a stream of other incomes other than their main businesses. Let me actually just look at one financial statement of a bank. But when you're looking, remember, when you're looking at the gross profit that is strictly sales minus cost of sales, okay? Could be rent income, royalties. Actually, I think, did I answer that question? There are many income gain on disposal of an equipment if you go and sell an equipment that you're disposing, okay? But I've done examples on this. I think I have a very concrete statement of profit or loss video that is now at intermediate level. You can watch it after this. You can watch it after this. Then we have Henry, I'm able. Yes, Mohammed, that is, we are going to have for partnership. We are looking at partnership. Someone is able to access our schedule, I think on Sunday. Yes, and company on Sunday. On Sunday. Yeah, please just check our schedule so that you don't miss these sessions. I know there are some who are preparing for next week exams. Please don't miss the sessions. And if you are here, make sure you subscribe so that when I start the live, you are notified. You are notified. Who is on TikTok? Thank you, Henry. Lindsay, I hope you subscribed on YouTube. Now, assuming you have given a figure for bad debts written off, does it affect P&L and but yes, it does. Yes, it does. It does. When you do an allowance for bad debts, you have to. It affects the statement of profit or loss. You've seen how it does the profit and loss today in our example, and it also affects the statement of financial position. Did it commission depending, are you receiving the commission? Is the business one that is receiving commission or paying commissions? We need that context. Lucky Johnny Mama Princess, let me know. We are talking about the commissions that the business is receiving or giving maybe their sales people. Let me know that. Keep liking the live, keep asking the questions. For sole proprietor, we've looked at the statement of profit or loss today. We're going to look at the statement of financial position. You're going to realize this statement when it comes to a company, sole proprietorship, they are the same. So what we are adding for partnership, it's the other accounts. And also for manufacturing company, we're looking at manufacturing accounts, okay? But the statements similar, they are similar in how we prepare them. Okay, Lindsay, thank you. Make sure if you're here, you've subscribed to the YouTube account, you have your notification button on. Okay. Royalties paid in. So make sure you people, you have you have subscribed to the YouTube. Make sure you've subscribed to your YouTube. I'm coming to your question, Haman. Just a second. I'm trying to handle. Sunday, it's there is a schedule, Stephen. I hope you follow me on my socials. Just a second. Proprietor account, that is well noted. try. Mhm. Let me get your question, both receivable and payable. And what was the question? Okay, then okay, let's start with royalties. So royalties, if you're being paid by another company, that is income. That is other income, okay? If you're being paid by another company, that is income. If the other company that is paying you, that is an expense to them. This you're going to find in the statement of profit or loss, okay? So for the royalties paid in from another person, maybe they are paying to use your brand or anything, then that is other income. Them that are paying in their statement of profit or loss, that is a royalty expense. Now let us come to commission. The same thing when you're looking at the commissions. If you are paying commissions, then that is an expense. If you are being paid, the business you're being paid, then that is other income, okay? Like a Mama Princess. And then quantitative, I don't do quantitative analysis, but in the future I intend to have these courses that someone can purchase. But I deal mostly with, when it comes to what you're going to find on my YouTube, you're going to find on finance management, financial analysis, financial accounting, management accounting, audit, taxation, okay? Hi, hi. Hi, Jan DY. Now we know who it is, but it is me. Just chat ni nani? Chat. Okay. Hello. I know you know me. Oh, Jandy. Hi, Jandy. Hello. Hi. Welcome here. So I'm saying for the people who are here, because I'm about to end the session, for you not to miss the sessions, there's a schedule there, and just go subscribe. My YouTube name is Accounting and Finance Playbook. There is a link on my TikTok stories and also my bio. I also have a link on my bio. I'm about to end the sessions. The people on YouTube, maybe some, you can just do the last questions. We close for today. I have a tax question asked. My YouTube is Accounting and Finance Playbook, just as it is on TikTok. There's a link on my bio. There is a link on my TikTok stories. There is a link on my TikTok stories. There is a link. Go subscribe. Once you subscribe, I start streaming. You are not going to miss the stream. For the people still on YouTube, let me know. Just drop in the questions if you have any. Drop in the questions if you have any. Steve God's, you've got the Steve God's beloved. Have you got the YouTube account? Lil noted. Lil Sadiu noted. Okay, nice, Lindsay. Nice to hear. Thank you, thank you. For more videos, you're going to find them on YouTube. Remember, tomorrow we are looking at the statement of financial position. Today, we've looked at the statement of profit or loss. I'm going to have a pre-recorded video out for, also yesterday we looked at the bank reconciliation statement. Also, you're going to find the video on YouTube. Per diem limit. Oh, okay. I'm trying to get the context. I have a lot of context of per diem including what is not allowed in terms from audit perspective. Maybe you give me more context. How often do you do the lessons? There is a schedule release on weekly, but I've decided I'll do a monthly one. But the frequency is 3 times a week. But now we're going to, this week, I'm going to be live the whole week, including Saturday twice, Sunday twice. There is a schedule out there that I have pinned. Okay. Okay. Keep liking the live, keep liking the live, keep liking the live. Okay, thank you, thank you, thank you. Let me know the people who've joined, you're able to subscribe. You're able, once you subscribe to YouTube, if I go live, you'll be notified, okay? Oh, Lindsay, okay, okay, okay. Thank you, thank you, thank you. And the first 10K. No. Okay, okay. Yes, correct. But depends on, we look at many, but when we look at not-for-profit, you can't tax them because of the places they go. It depends with the scenario. But I think 10K is, yeah. Yes, we usually stream on YouTube weekly. Thank you, Lindsay. Thank you, Lindsay, for that. I think for education purposes, yeah, 10K, yes, correct. As we close. Do I do physical classes? No. I'll find I'm your online. Don't do physical classes. Yeah. I don't do physical classes. Sunday, I hope I answered your question, Stephen. On Sunday, we'll be there 12 p.m. There's a session at 12 p.m. There's a stream at 8 p.m. On Saturday, there's a stream at 12 p.m. and another one at 8 p.m. Let me know. Let me know the people who are joining. Make sure you subscribe. Let me know. I think always for the people who are benefiting from these sessions, make sure you share these to your friends or people who are undertaking CPAs, ACCA, you're in a diploma or degree that requires accounting. And for more videos, always feel free to check what we have already in the portfolio. Lil, Sadiu, discount allowed, discount received. We discussed that the discount allowed is basically an expense to the business because it's what you're giving to your customer. Then discount received, now your customer, if they pay early, they get that discount received. They get that discount received. As you join, make sure you go to YouTube, subscribe. I think I am at 3 we are at 307. Let's take this to 308. Let's take this to 310. We close it for today. There's a link on my bio. Just go subscribe. Let us get these to 310. 310 subs. We are at 307. I'm waiting for 3 people to subscribe. We close it for today. Thank you, Jenny. Thank you so much. Yeah, we can see I'm already tired. Thank you for the repeating. Discount allowed is for company to clients. Discount received is from suppliers to the company. Okay, so if I go by as the customer, I am going to be, if I pay early, let's say you tell me if you pay me before next week, I am going to give you a discount of this amount. Your invoice reads 10,000, but you've allowed me to pay 9,500 only if I pay before this day. And if I manage to pay before that day, that 500 that I have not paid, that is discount received that I have received as a client and is recorded as other income in your statement of profit or loss. But now the other person that you have bought, that you've bought from, that is your supplier. Remember, you would have paid them 10,000, but you've paid them 9,500. The other 500 that they have not received, that is discount allowed, and that is an expense to their business. Okay, let me know that's clear, deal. So I am saying we are at 307. Let us take these the YouTube account to 310. Two people remaining. Two people remaining. Two people remaining. I think I'll end the stream on